Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Today, we are going to cover bonds 101. What are they? Where can you get them? And how much should you have in your portfolio, if any at all? So first, what is a bond? A bond is essentially an investment where you loan either a company or a government money and they promise to pay you back. At the end of that payment period, let's say 5 years or 10 years, they will give you back your principal. For example, let's say I invest in a Walmart bond or a state of North Carolina bond. I say, look, here's $1,000. Every single year for the next 5 years, you're going to pay me 5%. And then at the end of 5 years, you're going to give me my $1,000 back. That is it. That's essentially what a bond is. Now, some bonds are better than others, and that's all based on who the creditor is. Who am I loaning this money? Walmart, state of North Carolina, the city of New York, those all might be fine, and the risk there is based on how much they're going to pay you. So today's environment, I don't know, 3, 4, 5% bond, that's fine. That's normally solid. Now, if you find a bond that is paying you 22% like Carvana, that's a signal to say, hey, look, they're pretty risky. They may not pay me back because it could go bankrupt. Back in the day, 2007, 2008, Detroit bonds, the city of Detroit, was going through some financial struggles, and their bonds were paying pretty well because the risk was very high back then. So we have what are called bond grades. This is by a company called Moody's, and they give a grade for every bond. AA bonds, AAA bonds, all that type of stuff, and they basically tell you how, I guess, resilient or how strong these companies are financially and these government entities are financially. And that's going to tell you whether or not it is safe to invest or trust this company or city or state with your money. Now, the safest investments in the world, and this is, every textbook will tell you this, are U.S. government bonds and I bonds. These have been extremely popular in 2022. I did an entire video on I bonds, so I'm not going to go over that one again. However, there are 3 different ways that you can get bonds. You can go directly to the government, like I bonds, and get you, an I bond, treasury bond, whatever it's going to be, and go directly to the U.S. Treasury to get it. I don't really like that way because sometimes the websites are really antiquated and it's just a lot of extra work for very little money. And because you go to the lowest risk, because as long as the U.S. is collecting taxes, you are going to get paid. Therefore, they don't pay you a whole lot. The risk is very low there. In fact, banks put their money in treasuries, and that's how they keep, interest and do all that kind of stuff and pay you what is usually left over because they're investing their money in those places. Now, after you got the government, then you've also got direct bonds that you can get from a Fidelity and invest directly through individual companies. So I can go to Fidelity just like I would buy an Apple stock. I could also go through a Fidelity or even a TD Ameritrade, depending on what app you're using, and say, hey, I want to buy, $2,000 or $3,000 or $4,000 of Apple bonds and see whatever Apple is paying based on their duration. So 5-year, 3-year, 1-year bond, whatever time frame that they have available for you. And then lastly, which is the most popular way, is to buy what is called a bond ETF. So similar to an index fund where I have a collection of stocks. So tech index fund, S&P 500 index fund, however it is you want to look for it. You can also do a bond fund in the exact same way and say, for example, BND, this is the U.S. Total Bond Market Fund. So we take all the bonds together, create an ETF, and allow you to invest in it on your behalf, so you don't have to go through and find individual bonds. Now, in my experience as a financial advisor, it is extremely rare for people to buy individual company bonds. That's not to say that it's not impossible. It's not to say that people don't do it. The majority of people, in my experience, I'm somebody who opened accounts, who invested on people's behalf. They will call me and say, I want to invest in X, Y, and Z. Very, very rarely do I see people invest in individual bonds. Why that's the case? I mean, partly because it's harder to find and it's not as savvy. You can't really get in and out as easily as a regular, bond ETF. But just to throw that out there, I would say, in my experience, again, 95% of people, if they're investing in bonds, they're investing in a bond ETF. Again, BND is one of the ones, the stock symbol for that, is one of the most popular. Now, why would you invest in a bond? bonds are typically, I say typically because 2022 has been weird, but typically bonds are known to be safer than stocks. And because risk versus reward, bonds don't normally return more than stocks. You're talking like 3 to 5% on average, depending on how the market is doing. So for example, think about it. If I own Apple, then Apple is going to be subject to how many iPhones are they selling, what is going on in the market, are they producing more iPhones, not producing more iPhones, what's happening in China. Like, so many different things can impact the stock market. And if Apple were to go bankrupt, which I don't think they will, but if they were, I get nothing out of that. That's just it, right? I can lose 20% in a year, or I can make 50% in a year. It's risky. It's riskier rather. However, if I have a bond, the thought is, as long as Apple exists and as long as they are doing moderately well, they are going to pay me back my interest, and I'm going to get my $1,000 or whatever denomination that I have at the end of the term. So bonds are usually pretty stable, don't really drop as long as you hold them, and you're usually going to get your money back. So therefore, people in most cases, when we're looking at the stock market case, or you're looking at what a portfolio should look like, you're supposed to have, and again, this is just the textbook case, you're supposed to have some percentage of your money in stocks, some percentage of your money in bonds. And the older you get, the more that you want to have in bonds, because again, if the market drops and you're 85, 75, 95, whatever age you're closer to retirement or deeper into retirement, you don't want to risk that money. You want to make sure that your money is more guaranteed and less volatile, less likely to drop 20% in a year or 15% in a year, which is what we have seen so far in 2022. So that is the point of having bonds, and the way that most people get bonds are through ETFs. So I mean, that's really it. That's really it. Now there are dozens and dozens of different bond ETFs, and also this year bonds haven't done all that well the way they're supposed to in theory. The way it's supposed to work here, when stocks do good, bonds are like eh. When stocks do bad, bonds usually go up because people leave the stock market and go into bonds because those are considered to be more safe. Now the reason why bonds haven't done well is because interest rates have also gone up, and that shakes up the bond market in a bunch of different ways. Now, if y'all want to go into deeper detail about bonds and how they work with interest rates, feel free to let me know in the comments below. But this is just, level 1, part 1, 101 when it comes to bonds. But I just wanted to quickly come out and explain that because I don't think we've covered it on the channel in the past. Which bond fund do I invest in? B&D, that's just my go-to. For me, I have about 15 to 20% of all of my money in bonds, with the rest being in the stock market. Now, the reason I have that, and I didn't explain this earlier, is because of what we call asset allocation. That's the mix that you are supposed to have in the stocks and bonds. Now, remember, I said the older you get, the more you want to have in bonds. So here's how that works. Most people use either the rule of 110 or the rule of 120. That rule says I take 110 minus my age, my current age. That's going to give me the percent I should have in stocks, with the remainder left in bonds. So for example, if I'm 30 years old, then I'm taking 110 minus 30 gets me 80. 80% of my money should be in stocks, 20% should be left in bonds. So perhaps I could do 80% in ITOT. That's one of the most popular U.S. total stock market funds. So that means that all my money in that ITOT, that particular fund, I'll just put it here, it invests in all the stocks in the U.S. So 8% of my money can go in that. I got all the stocks. Really shouldn't have to worry about much if I'm investing for the long term. And the rest can go in something like BND, and that's the U.S. total bond market fund. There I go, 80-20. And that's it. That's all I have to do. Then every year I'll come back and just make sure that it is as close as I can get to 80-20. If I'll go back and find out that it is 50-50 because the market has changed so much, that's a problem, right? That's not in line with what my allocation should be. Now, for my kids who are 2 and 4 at the time that we're doing this video, I think 100% of their money is in stocks. They're fine. Right? They ain't got nothing to be worried about until they turn, I don't know, 20 or so, and then maybe they'll have 1% in bonds or something like that. However, if I'm looking at somebody who is, let's say, in their 60s or 70s and they have 90% in stocks, I'm a little bit more concerned, right? Because it's usually taking on way too much risk based on what their risk profile is usually at at that point in time. You want to kind of move towards protection the older you get, because you'll want to take a 20% loss right before retirement or even in retirement, because that can drastically shift your financial goals. All right. That is a 101 primer on bonds. If you have any additional questions on bonds, how to get them, or any like real details on like how they work with interest rates and all that kind of stuff, feel free to let me know in the comments below. I am here to help you. If you want to learn more about the stock market, then you can also check out our members only. We talk about the stock market every single week there, and we go into deeper dives on the market in terms of what stocks may make sense. We covered several videos on dividend stocks over the last few weeks, and then again we do deep dives and show you the ins and outs of what to invest in and what makes the most sense. All right, that is it for me. I'll talk to you later.